What I'll do is I'm going to cover everything fairly quickly, and then hopefully we'll have some good time for question and answer at the end. And like I said, I've been doing this for a long time, so I'm really welcoming your questions. Take some notes if you'd like, and let's get started. So my name is Peter Schultz. To make money in the markets, it's really important to have some tools for market direction, also to tell you when trends are changing. Of course, that's the entire point of this three-day round of presenters and presentations. But I'm going to give you today three fairly simple indicators you may have heard of before, but maybe even taken for granted, that can, in combination, be very, very effective, especially when you combine them with this one killer strategy that I'm going to show you that really stacks the deck in your favor. So my name is Peter Schultz. I've been trading every day for over 28 years. And I'm going to show you some things that will help you consistently cash flow the markets. And even though you're going to see three great ways to tell market's direction or an individual stock's direction, I'm also going to show you something even more valuable, how to really create a cushion in your trading to make it a little less stressful and a lot more successful, even if you don't get the indicators perfectly correct. So I'm going to show you a complete system for creating wealth quickly and safely. Now, this isn't gigantic gains. What I'm going to show you is how to consistently win with relatively little input and how those gains can actually accumulate over time. And one of the ways we're going to do that is to really create some probabilities that are in our favor. And I think if you've traded for any length of time, you realize that trading is actually a probability game. So whether you have the best indicator in the world or the best strategy in the world, it's not going to win every time. The good news is it doesn't have to for you to win in the long run if you are dealing with the right mathematical probabilities. So let's first take a look at these three indicators. And what we want to do is stack the odds in our favor right off the bat. So the first one, and I'm sure you've heard of this, is Bollinger Bands. So what we're trying to do is identify the overall trend and also potential turning points. So Bollinger Bands mark the high and lows based on the bands, and they provide a relative definition of high and low, not an absolute. So it doesn't tell you an absolute turning point. What it tells you is when things are starting to get stretched. So by definition, price is high at the upper band and low at the lower band. And what's interesting to me about Bollinger Bands, and what's always been interesting, and why John Bollinger noticed them in the first place, what you're seeing here is a moving average. We'll go into the settings, but this is essentially the bands that contain this movement are two standard deviations from the mean. What he noticed is how much of a stock's movement is contained in these two bands. The bands are created by using a middle line. So the middle line, the red line that you see there, is a 20-period moving average. So the reason I say period instead of day is because these bands work just as effectively if you have a 60-minute chart up, a 10-minute chart, a 1-minute chart, a daily chart, or a weekly chart. It's just periods. And it's amazing how effective certain kinds of technical analysis can be in all different time frames. So the 20-period average is shown in red, and it's flanked on either side by the blue lines that show two standard deviations from the center line. These two standard deviations tend to contain the vast majority of a stock's movement. It's actually surprising how much. So the math John Bollinger uses to create these lines tells us that, according to Bollinger, 95% of the price action will be contained within these bands. In practice, I found it's more like 90%, but that's still the vast majority of the price deviation, and it's useful to determining potential reversal points. Another great use is to separate periods of low volatility from periods of high volatility. So if I'm going to just grab my little pen right here. So just to show you some things, if you see a point here where the Bollinger Bands start to narrow, that usually precedes a big expansion, a big move one way or the other. In this case, it happened to be up. At other times where you see a big widening of the bands, like we see here, they get really wide. That foretells potentially, so we see this width at this point, some contraction or some reversion back to the mean. So another thing I want to point out about Bollinger Bands is that, for example, in this move right here, we had a gap down. It hit the Bollinger Band, and you'd think, okay, well, this is kind of a low. We should be anticipating a reversal. But what you'll see here is that oftentimes stocks can travel down one band of the extreme for quite a ways before it finally reverses higher. So I don't want you to use Bollinger Bands as reversal markers. What I want you to use them as a heads up to go, okay, we're getting kind of extreme and we might have a reversal here. One of the ways to trade that's been very effective, although this signal shows up fairly rarely, is when the stock really jumps outside the Bollinger Bands and you start approaching that third deviation from the mean. When you see that, you know things are getting really stretched, and chances are really good that you're going to see a reversal soon. So what this tells us is not absolute highs and lows, but it tells us relative highs and lows. So in back testing, Bollinger Bands are considered a semi-effective indicator with a 47% success rate when traders go long at the bottom of the band and short on the top of the band. The reason it's not a higher percentage is because of what we just saw right here, where it can travel down a little ways or travel up on the upside for a ways before it actually reverses. Still 47% isn't bad, but in this presentation, you'll see how to improve that success rate to over 80% by using some of the same bands, but slightly changing the strategy, actually changing the strategy a lot. So we're going to go on to our next indicator here. And once again, you may have heard of these before, but not really effectively use them. So this one is the moving average convergence divergence, or the MACD. One of the most famous and well-known trend following indicators. One of the reasons that well-known or commonly used technical indicators are so effective is for the simple reason that an awful lot of people follow them. So they say that that in the short term, stock trading or trading any market is essentially a voting machine. So it's the most people coming to the same conclusion at the same time pushes the stock in a certain direction. And so when a lot of people are watching the MACD, it can be very effective. So the MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. So it's an oscillating indicator. It's constantly moving up and down. And you'll see the Bollinger Bands in the actual chart on the bottom, but right here is where we're seeing the MACD on the bottom of your screen. It's an oscillating indicator fluctuating above and below the zero line. It is both a trend following and momentum indicator. So here's our zero line right here. So what you're looking for is changes. And one of the areas that gives you a little bit of a heads up, a little forward indicator, is not the actual crossover. So the crossover typically happens once the trend is underway. What I think is more interesting to follow is the histogram, which is these purple lines that you see here. So you'll see it go up like this, and then you'll see it start to roll over. And as you'll see, that's actually right at this point right here. That's before the turn actually happens. So we actually, if you were to trace this, you have one green bar heading up, and this thing has already started to turn over. By the time you get to the next day, you still got some really nice high market action and price, but you can already see this histogram starting to turn lower. That's a strong indication. Now we're combining this with a Bollinger Band. We already know it's this pricing right here is at 2 standard deviations. This is our blue band right here on Bollinger Bands. So it's ripe for, it could be reversing. We look down here at the histogram on the MACD and we see that it actually is reversing. It's starting to head lower. That's a really good indication we're going to have a reverse in trend here and things are going to start heading down. And boy, did it. It headed down substantially all the way down to the lower Bollinger Band and actually followed it down for a while right down here. So this gives you a kind of a heads up early indicator. So one basic MACD strategy is to look at which side of zero the MACD lines are on in the histogram below the chart. So that's down here where we've been looking. Above zero for a sustained period of time, and the trend is likely up. Below zero for a sustained period of time, and the trend is likely down. Potential buy signals occur when the MACD moves above zero. Potential sell signals when it crosses below zero. So what they're talking about there is, and this is just kind of some standard viewing and analysis on how the MACD works. They're talking about when it crosses this zero line. I would suggest a better place to look is at these extremes. So you look at these peaks when things are actually changing, when the momentum is changing direction. And like I say, if you'll notice, these peaks give you a little bit more of an early indicator than watching either the crossovers or crossing the zero line. And that's what we want. We don't need a crystal ball that looks way into the future. We really kind of want to know what's going to happen with this stock tomorrow and the next day. So signal line crossovers, and that's what they're talking about right here, or what this is talking about, provide additional buy and sell signals. So what the crossovers are, I've found, is actually a confirmation. So you see here that we've got a pretty significant downtrend here. And you see this in the histogram. It crosses the zero line. It's really heading south. We got this indication way early here, right when it started to reverse. And by the time we get to the crossover, we're already about 3 or 4 days into this trade, crosses the zero line. That's really good confirmation. But by the time that happens, you know, this thing is already well underway and heading south. Now you can make money on that. You can always make money on a continuation of the trend. But it's really nice if you can get good at nailing these reversals. So the MACD performs best during trending markets, like we've seen. And so here's on this particular chart, here's a nice, fairly long trend. If you consider each one of these being a day, this little downtrend here lasted quite a while, as did this. So we see this trend in both the histogram here and in the moving averages rolling over and actually crossing here. And then, of course, it going below the zero line. So this is all confirmation of this longer trend here. Sometimes we need confirmation to stay in a trade. So it performs best during trending markets, especially when combined with the MACD crossover. The challenge for most traders using the MACD is that once the crossover happens, how much of the trend is left? But combined with the right strategy, the MACD can be extremely effective. So like I say, the crossover is really your confirmation if you want to stay in the trade and it's continuing to head this direction. We get further confirmation with it dropping below the zero line, but your earliest heads up is when this histogram starts to change directions. So here's one way to trade this, and this is selling put spreads. This is going bullish. Call spreads is going bearish. And we can just see this undulation on the line here. And we can actually see where the trend, here's on price, the trend starts to change direction. The momentum stops, it starts to go flat and actually decrease a little bit. That's a good time to go bearish. Down here, we have a huge red candle lower. We have a capitulation bottom and a reversal. And that is actually reflected slightly ahead of time by this histogram starting to turn up. So these are good points to change your bias on the market or that particular stock. So our third indicator is on balance volume. So volume itself is a valuable indicator. So when a move happens on a stock, you want to look for some fairly substantial volume. Like I say, the market is very much like a voting machine. So when you get a lot of volume, it's an indication that a lot of traders feel that this particular turn or this particular move in the market has legs. But on balance volume takes a lot of volume information and compiles it into a single one-line indicator. The indicator measures cumulative buying and selling pressure by adding up the volume on up days and subtracting the volume on down days. So ideally, volume should confirm a trend. A rising price should be accompanied by a rising on balance volume. A falling price should be accompanied by a falling on balance volume. And if it doesn't confirm, look for the trend reversal. So here's a good example. Right here, we have a falling price. It's a trend to the downside. the stock is essentially sticking to its lower Bollinger Band. And when it does recover, it usually recovers only to the middle line before trending lower again. And here's our on balance volume down here. We see this very sharp downtrend. Now, here's what's interesting. The price recovered here, bounced above the center line all the way up to the top Bollinger Band. We see that same recovery starting here with the histogram. But the histogram on the MACD is telling us it's leveling out. We're starting to lose momentum. Now, the on balance volume is kind of our overriding indicator. This is our check. We see that it goes up slightly, except the overall trend in on balance volume is still to the downside. So you'll see that even though price is heading higher, this on balance volume is a higher high than the subsequent high. And actually from this point onward, on balance volume tells us the true trend. So take a look at the price in the top graph here, and then take a look at on balance volume and which one is telling the truth. So yes, we have a huge bounce in price here, but we should stay bearish on this overall stock. And we can see here when it peaked out here, and we can see the peak on the histogram. So that tells us that a reversal is coming. We see the peak here on the on balance volume. This is a good time to trade a reversal. This is, and the reason is we have divergence here in the on balance volume versus the actual price. It's heading up slightly, but it can't make a higher high, even though this high in price is actually higher than the previous high. And if you were looking at price alone, you'd say, okay, this thing is breaking out. It's going higher. It's achieved a higher high, and that's my indication that this thing is going to run. But the MACD and the on balance volume are telling a different story. The MACD is turned down, and the on balance volume creates a lower high, indicating that the volume, the buying, the voting machine is not really getting behind this stock to push it higher. So it's really important. And the reason we use 3 indicators, I don't want to use 4, 5, 6, 7. I want to use too many because it starts getting confusing. We want to use 3 good ones that work together. And if they're all lining up at the same time, that's a really strong indication. But when you have a deviation like this, when one of them is telling you, this downtrend is still intact, they're not buying this stock in a greater volume than they were before. And there is a really good indication without that buying interest behind it, without that volume, this thing's going to roll over. That's exactly what it did. This was a super tradable turn right here. It went from its top of its Bollinger Band all the way to the bottom in all these trading sessions. You could have stayed in this trade the whole way and really done well. So on balance volume tells us not just the turn or the confirmation of the trend, but it tells us the vote. And that's so important. How many traders and what percentage of the market is really behind this move? So as you can see, the on balance volume has been trending consistently lower in spite of some pretty big intermediate term rallies to the upside. So this continuous downtrend. So this is pretty level here, even though even though the stock is starting to go down, on balance volume is okay until it gets to this high here. And then from that point, it just looks like a stock trending lower, even though there's plenty of bounces in the price. So what it tells us is to sell these rallies as more downside is likely coming. Obviously, the reverse is true when on balance volume is rising. So if we would have gotten, so with this big move right here, if we would have gotten a higher high in the on balance volume, it would have told us that the whole market is getting behind this move and it's really time to switch to the upside. Until that happens, we don't really have confirmation. This is a rally that's a good one to fade. So look for divergence between indicators to try and pinpoint market reversals. Most often, the market reverts to its previous trend, and on balance volume confirms that trend, even if the market reverses temporarily. And here's where we see a really strong arrow to the upside here. The stock looks like it's really taking off. This peak even superseded the previous peak. It's a higher high. But down here in the on balance volume, we're just not seeing it. It's just not able to rally. And then, so just using the on balance volume against price, you know that this rally was a little weak, might be a good one to fade. But look right here at the histogram on the MACD, when you start to see that turn, and that gave us a really early signal. I mean, if you trace this up directly higher, it's actually right in the green bars here where this started to turn. And already it gives us a heads up that this big rally right here, this big green bar and rally, is likely to reverse. And of course, that's exactly what it did. So look for divergence between indicators to try and pinpoint market reversals. And for confirmation of a turning point, look for divergence in price and also the MACD histogram. So this is our real early warning signal here. So this combination, this particular combination of indicators works well for straight directional trading when they all line up. When they all confirm, you can stay in that trade until you see some deviation. But it works even better with another strategy. So what we're doing is we're trying to come up with some indicators that are not correlated, that all kind of either confirm or give you an idea of some divergence, something to look out for a market turn. And even with that, if you're straight directional trading, it can be a little dicey. I mean, this works really effectively for marking turning points, but there's probably something more we can do. The beauty of these three indicators is they're not correlated. They work together to confirm a trend or mark a turning point in a trend. When all three tell you the same thing, you've got an extremely high probability setup, and that's what we're looking for. So they work well for directional trading, but they work even better using a strategy that gives you a massive probability advantage. So keep in mind, what we're trying to do here as traders is always increase our probability of winning. So what's the best strategy to give you a massive probability edge? What is that killer strategy that's so effective you can make money even if you don't time the indicators perfectly, even if they don't actually nail the turn? What can we do to give us a little cushion, a little winning edge that just kind of really tilts the playing field in our favor? So the trick to making money quickly, easy, and consistently using these three indicators is to use a strategy that stacks the deck overwhelmingly in your favor on every trade. The key to winning over time is to stack probability on your side. So what can we do to do that? So what I started off doing, I traded stock for a while early in my career, and then I realized that options give you a much bigger lever. They take a small amount of money and they get it to act like a big amount of money. And I used to buy puts and calls like most people do when they first get involved. But what I started to realize over time is when I was buying, and a lot of options traders come to this conclusion after they've blown up their account 2 or 3 times, is that they're probably, even though the trade setup looks good, and even though everything looks in their favor, they enter the trade and their probabilities of winning just aren't that high. So yeah, you can make a lot of money when things work out, but an awful lot of the time they don't. So for a while there, I was really feeling persecuted. And then I finally started taking a hard look at those probabilities based on the Black-Scholes pricing model. And I realized that the best use of options, because they're based on a mathematical formula, is to use them to stack the deck in our favor. Once I figured that out, once I got on the right side of the options trading formula, absolutely everything changed. What happens is a lot of the time we think that our winning edge is us. We're going to be that much quicker. We're going to read the charts that much better. We're going to use that much better indicators. We're going to be Johnny on the spot with our mouse. We're going to get in just when we should, get out exactly perfectly. And the truth of the matter is, once you've traded for a while, you realize it doesn't really work out that way. There's just too many variables in the market. You can wake up one day, there's a big gap one way or the other. There's a big move in one direction. Some news comes out overnight. Your best trade setups and some really good things that you put together suddenly aren't working. This gets frustrating over time. And what I realized is what we need is a winning edge that works with or without us. And if it's really good, if we really stack the probabilities in our favor, We don't even have to watch our trades that closely. So the way we'll do that, well, the way we'll get that edge is to use options because of their built-in probability of winning. And you only get that built-in probability of winning by switching from being an options buyer to being an options seller. And by doing that, we'll instantly stack the deck over 80% in our favor on every trade. And our three indicators actually increase that probability of winning. But just based on the Black-Scholes pricing model, just that mathematical formula that made options trading possible in the first place and that won the Nobel Prize in 1998 in economics for the mathematicians that discovered it, just by using that formula and placing our trades in the right place, which I'm going to show you how to do right now, we're increasing our odds by over 80%. You use these three indicators to confirm a trend or mark a reversal, and your odds become overwhelming. Yeah, yes, you can still lose, but it's an unlikely event, as you'll see. So let's see how we actually do that. So this is a trade we put on not that long ago. You can see that it's trending lower. We have a series, in the simplest technical analysis, we have a series of lower highs. And here we are hitting up against that resistance. So you could take a straight directional trade right here and buy puts on UPS. We've also got, take a look at this MACD histogram. We've got right here at this green bar, right here at the peak, we can see it peaks, and then the very next day it starts to roll over. So we didn't actually put on this trade. If you look at the mark here, we didn't put it on until the next day. We didn't put it on until the stock actually confirmed that it was rolling over. Now take a look at on balance volume. Take a look at how it just completely rolls over right here. And actually we get a little bit of an indicator of that before the stock actually rolls over. So this is a good one to look at. So what we're doing is we are selling, see if I can actually spell by using the mouse. We are selling an option right here. In this case, you can see off to the side here, it's the 152.50. We jump up here and we don't, when we sell an option, we're giving somebody the right to call it away from us at 152.50 for any time up until this finish line here, which we typically sell about 10 days a time. We'll sell on a Tuesday morning. We get the weekend, which is free time decay. That's Saturday and Sunday. And then these trades are typically set up to expire the following Friday. So you have the entire next week, those 5 days of trading. We put it on Wednesday morning. So the morning we put it on, we've got that Wednesday's trading, Thursday, Friday, and then the next week. So that's actually 8 days of exposure in the market. And the reason that we sell at that point on the time decay curve is what I found is those 8 days, 8 trading days, 10 actual calendar days, give you enough time to get a really good credit. So what we're doing here is, as you can see, we're selling completely out of the money. This is way above where the stock should go based on its current trend and based on it rolling over on the MACD, rolling over on the on balance volume, and just kind of what's generally going on with the market and what's generally going on with that stock. So we're selling out of the money. So everything we sell is time value. So those 10 calendar days actually can give us, especially in a volatile market like this one, some pretty significant credit. So everything we're selling is time. And then since we have $1.50 spread in between here, but we got a 57-cent credit. So the most we can lose is the distance between these two strikes, which is $2.50. And we, this 57-cent credit, we get to keep no matter what. So that 57 cents we subtract from the 250 potential loss, we get $1.93 at risk. That's absolutely the most we could lose if things really went sideways. But a 50-cent credit divided by $1.93 risk gives us a gain if this stock never gets into our spread and never touches our spread. So look at the probabilities here. This is why we have over an 80% chance of winning on every trade, because we're selling out of the money and we're selling in the opposite direction. Here is
Hey,
an actual trade. Yes.
oh, you
Did you,
you cut out for a second. Uh,
okay, so how far back should I go?
about a minute almost, maybe 30
Okay,
seconds.
so did I just come back in?
Yeah, yeah.
Okay, great. Okay, so what I'm trying to demonstrate here is that we're going to sell this option. It's quite a ways out of the money. It's in the opposite direction that the stock is actually trending based on our indicators. So this indicator hit the top Bollinger Band. We see the histogram rolling over here. We see the on balance volume rolling over. This is a good trade all by itself. And then what we do, we sell, we take in a really nice credit. We buy another option just above it. So we sold the 152.50 call. We bought, as you can see off to the side, the 155 call. So we've hedged ourselves. The
Hey, Peter. Peter, are you there?
hello,
Yeah,
David, can you hear me?
yeah, yeah. It's like you keep hitting a mute button or something.
I'm not hitting a mute button. I think what's going on is the internet is being kind of intermittent.
Oh, okay.
So it's not mute. It's just an iffy connection. And let me know if you want me to back up, and I can sure back up and cover anything. And then hopefully we'll have a good connection at the end. I can answer any questions of some blank spots.
Okay. Yeah, just it, it was just a slight drop this time.
% return here. So normally I'd be very satisfied with a 40-cent credit on this. And keep in mind that if 40 cents doesn't sound impressive, of course, with options, everything's multiplied by 100. One contract, you're going to get 40, 10 contracts, you're going to get 400, 100 contracts, you're going to get 4,000 in credit. So you can really adjust this anywhere you want. And I've got some of my traders that constantly do 100 lot contracts. I mean, that's what they do, is 100 contracts at a shot. But just for purposes here, what'll happen sometimes, and you can see on this red bar, the day that we put on the trade, it popped up really high at the open. We got a nice 57-cent credit on this. And so that 57 cents we get to keep no matter what. Now that could be $5,700 in your account, could be 570, depending on where you're at. But the most we can lose on this trade is the distance between the strikes, which is $2.50. So you take that 57 cents, you subtract it from the 250, we get 1. So that's our risk. So a 57-cent profit on a 193 risk equals a 30% return for just 10 days at time. And that's actually only 8 days trading. The beauty of this strategy too is you don't have to do anything to exit the trade. I'm going to show you the right way to set stops on something like this. So once this trade is in effect, you just kind of let the market take over. Now we also do some fundamental analysis. So in this recommendation, I do a big write-up about the recommendation. You just don't get a chart. You also get a lot of the facts behind it. But earnings were coming up on UPS, and I thought with the economy going the way it was and some of the warnings UPS had come out with, I thought their earnings weren't going to be great. As you can see, the trade was working for us. This had already rolled over, and then they came out with earnings. This thing gapped down massively while we held this call position. And that just automatically gets you to pretty much full profit on this thing. We're going to let it go to expiration to collect our maximum profits. But all we have to do is see this thing go away from our position that we've sold up here, and we're doing fantastic. So let's move on to the next chart real quickly. So this is the SPX. It's one of my favorite vehicles to sell options on. It's very liquid. You get really good credits, very narrow bid-ask spreads. It's a very efficient thing to trade. So what we saw here, and this commentary that you see right here, is I lifted this directly from our recommendation on our subscription service. So you're seeing exactly what my subscribers get. The SPX is having a hard time recovering its previous uptrend. The big index made it up to its old trend line, but that often turns into resistance once broken. With so many big cap stocks trending lower, the XPX the most likely trend from here is down. So as you can see, when we made this was right here, it just hit horizontal resistance. And when this uptrend line was broken, that turned into new resistance. So oftentimes we'll see when a trend line is broken, the stock climbs back up to that trend line and then reverses sharply lower. So we put on our spread way up here with the SPX because it has big numbers. It's a $5 spread. So we go for $1 on that one. $1 credit on a $5 spread means you have $4 of risk. And when this expires, you're going to end up with a 25% return. And this is exactly what we shoot for. Now, keep in mind, you're only in these trades for 10 calendar days. So when I use examples, I say that you're turning your money every 2 weeks. You're actually turning it faster than that with very little effort. But you can see the likelihood of this trade winning. We've already formed a new downtrend. We're hitting resistance. This was at the top of the Bollinger Band, and now it's reversing back to the mean. And we get this big clue here where we have a crossover here on the MACD. And even back here, when the thing peaked, after that, right here, we start to see this head lower and actually accelerate below the zero line. Now, the S&P 500 does not have on balance volume. They don't keep track of that. We can keep track of it on all of our stocks, but we have enough indicators here in the actual price chart and what the MACD is going to have a pretty good idea that there's going to be a reversal here, and boom, that's exactly what happened. You see this big gap down the very next day. So one of the things I want to point out here too is we don't need this massive reversal. Even if the stock just traded sideways. In fact, one way to look at this is there's only 5 things that a stock can do at this point right here. It could go radically higher. It could go a little bit higher. It could trade sideways from here. It could go down a little bit, or it could do what it actually did, which is drop like a rock. Well, this scenario, when we've sold a spread way up here, way above where the underlying actually is, out of these 5 scenarios, we make money on this one, we make money on this one, we make money on this one. We even make money if the thing goes up slightly, but it never actually hits our spread. The only way you can get in trouble is if 1 out of 5 of these scenarios actually takes place where the thing goes up radically, and every indication we have tells us that it's rolling over. So in your mind, I just want you to be thinking about your probabilities of winning. Your probabilities of winning here are very high. And that's what we're looking for. We're looking for that edge. How do we know this is the probability? So on the Thinkorswim platform, which is, I'm pretty sure, still the absolute most popular platform for trading options, you can actually specify your layout. And in the layout, one of the things that I teach and that I'm going to let you in on right now is on our columns, we want this column right here to be visible, which is your probability of being out of the money. So on this particular trade, you can actually see your percentage, your probability of being out of the money with nothing else considered, not the trend, not the fundamentals, not the MACD, not the volume, nothing else considered. We have an 81.99% chance of winning. So you have almost an 82% chance of winning and are only in the trade for 9 trading days, maybe 10 or 8 actual trading days, taking out the weekend. and the current mark is showing a 25% profit. So this is a very high percentage trade. This is the kind of trade we like. So here's another one just put on here. This is on Estee Lauder. And my goodness, so you can see what the trend is on this one. This is not, you don't have to be a wizard at technical analysis to see what's going on here. So this is our write-up directly from the subscription. This is exactly what the subscribers saw. The prospects on EL are not good, and that's reflected in a sharp sell-off after earnings on May 1st. So this is that sell-off. Just absolutely crashed the stock. The market did not like the results. They did not like the forecast going forward. And since then, that downtrend has been confirmed very consistently, and we'll be selling both above downtrend and horizontal resistance. So here's horizontal resistance. You can see it very clearly here. This is downtrend resistance. One of the things that confirms this downtrend is you can see that even when there's bounces, they only make it up to the center line before reversing lower. So the entire price action of this stock is contained in the lower half of the Bollinger Bands. Very typical of a consistent trend to the downside. We'll see that we got a slight blip higher. That allowed us to get a really good credit here. And so this is actually one of my favorite spreads in terms of the strikes. This is a $2 spread. So we sold the 104 calls, and that gets us just completely above both of these trend lines. And we bought the 106 to hedge. And so that's a $2 credit. That's our entire potential loss. And because this spiked up the day after we proposed the trade, we got a 51-cent credit, which is pretty substantial. So the most that we can lose is the distance between these two spreads, and that is $2. So $2 minus 51 is $1.49 risk. A 51% profit on a $1.49 risk equals a 34% profit. Now, these returns kind of blow me away, considering that this strategy is pretty passive and you have such a massively high probability of winning. So let's move on. I've got a couple more charts here I want to show you and kind of delineate. And I really want to show you this one because this one kind of went against us. So we saw that the Russell 2000 really, there's just been rotation into the small caps from the big caps, and it just actually took off like crazy after a run like this. And we've actually exceeded the Bollinger Band. We're actually outside of it. You'd expect to see a pullback. When that pullback happened, we sold this spread right up here, and that's logical. And you can see some of the peaks here, and it still doesn't look like it's going to exceed it. But and this is, once again, this is the actual verbiage that you got. This is right from what our subscribers got on the chart. The only mechanism that could create this kind of straight up rocket launch is short covering, and the CPI print lit the fuse. Up a whopping 114 points in 4 days, the highs not seen since early 2022. So this is a really abnormal move. You'd expect it to retrace. And because it really did, this is so high, and it was jumping so much, we got bigger than our normal credit. We got $1.11 credit. This is a $5 spread right here. So that's 111. So it's $5 minus 111 gets us down to 389 of risk, and $1.11 credit on 389 of risk equals a 29% return. The reason, and this is all confirmed by the histogram going lower, the Bollinger Bands being exceeded, all of the indicators are that this would head lower. What happened is we got this big green bar. And one of the reasons I want to show you this chart is what to do when a trade starts going against you. We got this big green bar, and some time decay had happened already. So this 111 credit had been reduced quite a bit. When we got the big green bar, I thought, you know what? This could potentially go through our strikes. So I sent out an email, and also everybody has text. I let you know right away when to make a change. I said, you know what? We got some profit to protect on this one. It's not a lot, but why don't we close the trade, lock in our gains, and see what happens with this? and it turns out it did not exceed it. It actually turned around and headed back lower. I don't think it will get above this, but we locked in our gains. And that's another point that I want to make is you don't need to let these go all the way to expiration. If something's happening in between, you get a little nervous, or you've already realized most of your gains, you can close that trade, free up your capital for another trade, and book a really nice gain. So your odds of winning with this strategy are extraordinary, but the real appeal might be your ease of trading. Once you put on a trade, you simply enter a stop, right? Well, I'll show you. I'll do that in the next screen. And you walk away knowing that you have over an 80% chance of winning. And even if you don't win, your potential losses will be cut in half based on the automatic orders I'll show you how to enter. So not only do you have an overwhelming chance of winning, but you get to enjoy a pretty carefree lifestyle as well. And I personally really needed this in my trading. When I first started out, I was looking at screens all day long. I was watching the market bounce all over the place. I'd get frustrated when I thought was going to happen, or the technical setup that I was trading didn't actually play out. And it really started to bother me. I was thinking about the market all the time. It created a certain amount of stress and anxiety. And so what I love about this particular strategy, it gives you this really appealing this combination of being really high probability, where you're setting yourself up to win most of the time and you don't have to watch your trades much, and yet your returns are pretty substantial. So let me just show you this real quick. If this would have gone up, and if we hadn't closed it early, and it would have hit, say this jumped up here and hit our sold strike. Now keep in mind that this is a $5 spread. So if the underlying goes all the way through and ends up here somewhere, you're going to lose that whole $5 minus the $100.11 credit. In other words, you'll take a $3.89 loss. And that's why I say that this is our risk. I never want that to happen. If this thing jumps up and it hits our sold strike, it's a pretty good indication that it's breaking out, because whenever we sell these, we sell them above resistance on call spreads and below support on put spreads. So you have that. So if that gets touched, it ends up, it's a really strong indicator that the stock is going to keep moving. So what we do is right here at our sold strike, we enter a stop. And what a stop looks like with this type of trading is what we're actually doing is we're reversing this entire spread. We're buying back what we sold and we're selling what we bought. When you do that, it's the end of that particular spread. It no longer exists. But here's the interesting part. Instead of having a potential $5 loss, you got to subtract this $1.11 from. Options theory tells us that if we close our spread right here at our sold strike, our cost to close is cut in half. So instead of being $5, it's $2.50. Now, even in a losing situation, if we subtract the $1.11 from the $2.50, all of a sudden we have a fraction of the loss we would have had. Instead of, so in this case, it's the $1.11. This gets us down to 150, 139. Loss with a $1.11 credit that we already have. You know, we're almost just at 50% there. We've really, really reduced this. And the other thing about this is now keep in mind, you have an over an 80% chance of winning. It only takes one or two positive trades, winning trades, to make up for one loss. And that's a really good ratio. So one of the tricks to this strategy, and I'll just tell you right now, is set your stop right at your sold strike. That should never be hit. If it is hit, it means the stock is breaking out in a direction that we didn't anticipate and that the charts told us wouldn't happen. So we target 25% per trade. As you can see, we sometimes get more than that. But what is an attainable return you can expect over time? So, you know, in trading, you know that there's losses. We set aside cash for buybacks, for rollouts. So we're going to have to reduce. Let's say I want this to be conservative. I want this to be something that you feel like you can attain and really is attainable. So we can drop that 25% to 20%, 15%. A lot of my traders, especially when they buy back early, are making it consistent, no problem, no sweat, 10% per cycle. which is less than 2 weeks. But I want to get this down to a number that I know anybody can do. So let's lower it to just 5% right here, an amount I know anyone can make. And the key is you're turning your money actually every 10 days or so, but let's just call it 2 weeks. So let's see what that turns into, starting with just a $10,000 account. Now, this 5% factors in losses, having to use some of your cash to buy things back, to roll them out, to do all kinds of things. Let's see what happens. So here's the graph, and it's pretty impressive. So 5% compounded every 2 years, every 2 weeks for 2 years, takes your 10,000 initial investment, grows it into over $104. And based on that, based on 5% every 2 weeks, you're bringing in over $10,000 per month. So what a lot of people use this for, what a lot of my subscribers use it for, is as a cash flow strategy. Now, if you go to Wealth Builder Publishing, which is our website, we have actually a lot of strategies to make massive amounts of money over time. We get in on really small companies with really high potential. I make friends with management. I get to know them. I get the inside track on the stock. I know what they're going to do. We buy massively undervalued companies with incredible technology. That's a way to actually become a millionaire. And many of my subscribers have. We've had some incredible deals there. But before you become a millionaire, you want a way to create cash flow. You want a way to create enough money coming in so that working becomes optional. And this is the best strategy I've ever seen for doing that. Now, does this graph go like this in the real world? Does it just go up every single week and just continue to go up until you've created this massive amount of money? No, of course not. The market is unpredictable. It's wild. There's volatility. Sometimes you can get surprises. These bars on here are always going to go up and down. It's never going to be this even. But what if it's even close? What if you're even close to this? This is the best cash flow strategy I've ever seen. It just stacks so many probabilities in your favor, especially when you're using these indicators to tell you when there's turns. So you can try this strategy out for yourself. You've actually got some good information today to do that, starting with as little as 200 per trade. Does not take much to get going. There's just one problem. If you lose, if you don't do well right off the bat, you might disregard the whole strategy and quit. And that would be a shame, because this really is the best way to trade, because your high likelihood of winning, the hands-free nature of the trading, and the tremendous compounded returns over time. So to make sure that you start off profitably and stay that way, I put together an educational package that's the best anywhere for this strategy. And I've looked all over the place. I've been working on this strategy for actually I've been trading this for a long time, consistently with the strategy for over 15 years. And we're going to sell it at a fraction of the 2,500 sales price we used to charge. I'm going to give you a really good deal today. So the whole package is called The Winning Secret, and it includes right off the bat, you get a how to trade credit spreads for fun and profit. I get the biggest kick out of this screen and this picture. But it shows you how to step by step how credit spreads work, why they work so well, and how they can work for you. I think you'll get a kick out of this. I don't try and overcomplicate it, but I do give you some really good information. In addition to that, you get a 161-page downloadable ebook, complete with color graphs, charts, pictures, and everything you need to start trading profitably and stay that way. You get a 10-chapter video series where you can hear and see exactly what to do to start generating this income. And you'll also gain access to your archived webinars and video tutorials for life as an owner of this package. There's a lot here, and we add information to it all the time. And this is a one-time charge. Like I say, you're going to get a really good deal, and you get to keep this, and you get to keep all the upgrades. You access a password protected part of the site, and you get it all for life. Plus, you get videos that show you how to set up automatic orders with our favorite broker for spread trading to trap profits, whether you have time to watch the markets or not. This is the big time freer. This is what frees you up to really enjoy your gains without having to watch the market all the time. So there's two parts to this package. One is the education, which you have. The other is a subscription, where you get 2 new high probability trades per week. Now, for the subscription, there's a monthly charge. I don't think you're going to worry about that, because the market, if you're doing any trades at all, the market should pay for more than your subscription. one good trade can pay for the subscription for a year. But I'm going to actually include your first month so you can get started right with this package. So you'll have the education and you'll have the subscription. And then if you like it, and I think you will, I think you're going to do really well. You just continue that, continue the subscription, and you just keep cash flowing, keep making the trades. I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. I think you'll like this. You've seen a little bit of it already. Plus, you'll get an extra bonus, a 10-module video course on trading the weeklies. This is an extra. And I want you to get some one-on-one attention so you really know what you're doing. So I don't just throw you out there. Don't just give you access to the website. I give you some really good attention. This is Deanna. It's included in this package. You're going to get a one-on-one orientation to make sure you can really take advantage of the service. You know how to interpret it. You know how to open an account with the right broker to let you do everything. I think you're going to really like this attention. But here's the real kicker. Here's the icing on the cake. This is Alicia. She's our coach. She's one of the smartest gals I've ever met in my life. She's the one that I go over options trading principles with and different strategies. She's a finance major, was a finance major. She graduated from the college that we have here in town, and she's our options trading coach. We sell 8-session coaching sessions. We also sell a package of 3, and people just get these. They get 8-session packages just back to back. Is it because they can't understand the strategy and they need somebody to teach it to them? No, it's because Alicia helps them make money. And they look for trades together. They look over the market. She's really good. She's really sharp. Plus, I love her. And I think you're going to too. She has a great personality and a really good head for this. She's smart. So included with this package is you get a 45-minute coaching session. This is where you guys go out in the market. You identify trades. You identify good setups. And she can really help you make some money. And like I say, I think once you have one session, you're going to want to have a lot more. So the whole package here, everything included, you can go, the price is so good. I want you to go and check it out for yourself. It's at worryfreeprofits.com. And that's truly what we're going for, is being able to trade without having to worry so much. Go ahead and write down the URL. You can go there. You can take a look at the price. It's all inclusive. You get everything. It's a fraction of what we charged in the past. This is something I put together just for you watching this webinar. We're just about out of time. I don't know if we have time for questions. Oh, this is great. David's posted the